I see Suresh, Stephen, Phil, Alicia, Jonathan, Christy, Linda, Freya. See Aaron. Hello, Dr. Chandler. Dr. Chandler George. This is a topic that I could get Chandler on for. He loves to talk accounting. It's funny. You talk about other things, nah, he's not too interested. Acquisitions, not too interested. But talk about the boring, dry, how do I save money on taxes? How do I not pay the government so much money? And Chandler is all over those. Tom Nardone's driving. Looks like he's driving a camper or something. My word. Wow. Oh, Tori's on too. He's going to be here at the Free For All event. So welcome, everybody. Well, before we get started, everybody, I just kind of want to welcome everybody. Thank you, everybody, for being on. Today, we've got Josh Belk with us. He's going to talk about some of the things that are going on with the IRS, how to save money on taxes, how to be proactive. Hopefully, we're going to get into some proactive stuff as well. So welcome, everybody, to the What's Going On in Real Estate calls. We started these about 2 years ago, about a year and a half ago, and we just do these free calls every month. I want to just let everybody know anybody can jump on these calls. So if you want to invite your friends, these are free. There's not a whole lot of upsells. We're not trying to sell people in anything really. I do allow our speakers to kind of let people know what services they offer. It's kind of like almost like a live podcast, but you can get to ask questions live at the actual on the scene. And sometimes, when you're listening to a podcast, it'd be great to be able to ask a question right then, and you don't ever get to ask questions. So that's definitely kind of what we're doing. But also right now, always kind of just want to know what is going on. The economy's kind of been all over the place the last couple of years. We have no idea what's going on. Trump probably got, indicted for 6 more things this week. I don't know. I saw some funny memes this week. He just got indicted for forgetting to put back the shopping cart. I don't know. It just seems like it's getting more ridiculous by the minute. So what's going on in real estate is kind of the reason for these calls. I do want to remind everybody, if you didn't get on last month's call, Allie Murphy did an amazing job. I'm telling you, she's a super smart girl. She's got her own CRM that you can work with. And the one thing about her CRM that's different than most CRMs is it's unlimited contacts. So most of these CRMs, you get up to like 10,000 contacts and your cost is going through the roof. So I'll tell you, you might want to check out that last call we had with Allie. Allie will also be one of our speakers at the upcoming Free For All event. Today, we've got Josh. Josh, welcome. How you doing, sir?
I guess I should unmute myself. Yeah. I'm doing well, Tom.
If you guys see there, he's a star, or at least his mom or wife or somebody thinks so, because you can see star in the background of Josh. He's a rising star. I've known Josh for, 30 years or so, super good friend of mine. He's my accountant. And we're going to talk today about some of the real estate changes and some of the things that you can do to be proactive. And also kind of like what's going on in that whole tax world right now, which seems to be changing quicker than you can even keep up with. Me since last month, I always like to kind of let people know about this. So me since last month, I have been busy at work. But I did get some time to go. Our nanny that had been our nanny for about a year and a half, Misty, got married last weekend. So got to go to her wedding. And then Zach memorized a bunch of verses and got to get a picture and a certificate with our pastor and his wife over the last week. Actually going down this week for Lindsay's wedding, another one of my employees in Tennessee, and on this weekend. So I'm excited about that. But this is what I've been doing. So me and my guys at my office have been hard at work framing up the back of my office where all of the fire damage was from our office. So we've been doing that. But also, if you've been to my office, this is a change. So the big area where we're going to be holding the real estate free for all, we painted that back wall black and we got some new chandeliers in there. It's all cleaned. It's ready to go. And my podcast studio, we haven't been able to do a podcast for about 4 months, and we're hoping to do a podcast this week. So I'm excited about getting that done this week. Me and Jared getting back in the podcast studio, and Amelia's help with that. My wife's help with that. So that's kind of what I've been doing. Working hard. I feel like I've got a second job, but hey, sometimes you got to kind of go through with what you got to go through. Upcoming, want to let you guys know about a couple of things coming up. Oh, that screen didn't work, Amelia. That's not good. Oh, there it is. Okay. So we do have the real estate free for all coming up September 7 through 9. But we also got John Morey's doing a conference, the Southern Charm Conference. And that is $385. And that includes 2 free lunches. And if you guys want to sign up, you guys can go to that website right there at the bottom. I believe that's going to be is that Athens? If you want to jump on, John, real quick and just let everybody know where that's going to be. I think it's going to be somewhere.
Well, actually, thank you, Tom. I really appreciate you allowing me to do this. And this event is actually going to be at Lake Guntersville State Park.
Okay.
It overlooks Lake Guntersville, so it's a very nice place. It's called The Lodge. This is just totally amazing. When the moment I decided I was going to do this, I went there. They said that room that you want is available, and somebody canceled. So I'm like, oh wow, that's great. So it's beautiful, it's nice, and there's a code you're going to reserve. It's 1293, and that's how you get the discount and all that. And it's going to be exciting, and in 1 week's time, we got all our speakers. I couldn't believe it either. Everybody
Awesome.
start pouring in. So it's going to be exciting. You guys know who they are, like Jeff Watson, Wendy Sweet, all those people. And it's on the website. If you guys want to go check it out, it's there.
So you guys can go to the website right there. That's on there. pay.southerncharm.com/southerncharmre. That's how you guys can find out about that. And I do want to let you guys know also, I told Tom and Peggy I'd promote this all year long. So the Investor Addicts Cruise is going to be next. I don't know when the dates are. I think it's on here. February 11th through the 18th. I know that rooms are booking up on that. I've got my room booked for this. And if you want to go have fun for a week and then kind of be trapped on a boat with people that you get to talk to day and night, that's definitely a place to go. I learned a lot myself on this cruise. There's what I like about this cruise. There's a lot of old timers on this. Tom's been in this business for a long time, and he's got a lot of friends that have been in this business for a long time. And in this type of market, the old timers are the ones that kind of flourish. And people that have been doing this for 30 years have seen a lot of different things, and they really know how to navigate this. So myself, I've been doing real estate full time for about 15 years, but people like this really know what they're doing. And I have a lot of respect for Tom and his network as well with this Investor Addicts Cruise. So investораddicts.com, get your rooms. I'm pretty sure that they'll sell out. So make that happen. And what better time to go on a cruise than in February, right? Especially if you live up north. So highly recommend this. Make that happen for you guys. If you guys haven't signed up for the free for all, September 7 through 9, it's in Gary, Indiana, and we are going to have a blast. It's a little different than the last 2 years. So if you guys have come the last 2 years, please note the changes. We're not doing an event the night before unless you're VIP. So if you're VIP or a speaker sponsor, we're doing a dinner the night before. And then other than that, it starts on Thursday morning at 8:30, goes to 5. We have live entertainment and food trucks that first night. And then the second day is kind of similar. We'll have karaoke, real estate horror stories that second night. And then the third day will be done around 2:30. So you guys can mark your calendars. You guys can fly in, fly out, or fly out later on if you guys are from out of town. If you guys are from in town, then obviously you don't need to fly out. But that's kind of what's going on there. Josh, one of our speaker today, is also going to be one of our sponsors and speakers for that event. Appreciate Josh for that as well. And these are the speakers. So Anna Kelly, REI mom, she's amazing. I promise you, if you are smart, you will love her. She's the one that will put up graphs and you'll still be like at the edge of your seat. Sometimes people put up graphs and you're like, oh, it's way over my head, but she understands how to connect with the audience. Adrian is just a super fun guy, does real estate. He does those types of homes. And Allie Murphy, super smart. Josh, one of our speakers. Jennifer's going to talk about setting up your CRM, not CRM, it's more setting up your FSBO for sale by owner. Brandon Rooks with Rockstar Investments, Hannah Kessler with life insurance, Tori Aguilar. I'm telling you guys, last year, Tori told us gold was on sale. It was $1,500 when he was at our meeting last year. If anybody's looked at where gold is at right now, there's not very many investments that were better than buying gold at last year's event. I'm not saying it's on sale today, but I'm telling you, he was right. It was on sale last year. Dave Overman, super fun. He spoke 2 years ago at our event, and you guys will like him. He's going to talk about mistakes he's made. Rick Bressler, Tom Barry. If you guys don't know Tom, runs a $100 million fund, super smart, didn't get there by accident. Jeff Shahusky spoke 2 years ago, a lender in the north part of the country, super smart. You want to connect with him. Augie Blaylock. We are going to be trying to raise money for two different things. Augie's going to be one of the things. The second thing is going to be for the senior trip from Hammond Baptist, the school that my kids go to. So we're going to kind of have two things for that. Seth Hardy is a local wholesaler, great at wholesaling and acquiring houses. He's going to talk about acquisitions. And Mike Kovachkov, I think, honestly, one of the tax sale experts in the whole country, and is local to us here in Northwest Indiana. He's also one of my attorneys as well. So I'm super excited to have Mike. He's going to be speaking. Amy and Brian speaking about short-term housing, and Fred and Beth are going to be talking about their village that they've created, this little village for kind of tiny houses, type of deal. But super excited to have all these speakers. We're going to have a fun time at this year's event. It's going to be great. VIP package does include guaranteed access, videos for the event presentations, all three of my books, a t-shirt, and a private networking event that night before. So there's probably $300 or $400 worth of just hard cost value that's going into that $99. And just remember, the sponsors kind of pay for this event, and they've done so for a couple of years, and I really appreciate them. So make sure that you let them know how much you appreciate them. But the free-for-all package, I promise you, is probably worth 10 times that. If you guys have not gotten your hotel, make sure you get those. But the links are on the hotel, are on our Facebook pages and everything else. If you guys have not joined the Facebook group, please join it and continue to ask questions. We're starting to get a little bit more traction on that. And as always, every time I get to speak, I want to remind everybody to be a conduit, not a bucket. This earth is not, we're not here just for ourselves. Find somebody else, find how you can and help them. Figure out what you've been given, whether it's been time, whether it's a talent, whether it's a treasure, whatever that is, and find a way to be a giver. My pastor made a statement this last week. I'd love to give it to you guys here. And it's so true. He said, givers somehow, some way, always have something to give. Think about that. Think about that. Givers are always given something to give. Just let that sink in. I'm not going to explain that and go in any more further detail, but I think it's a great statement, and I think it's a good statement. I love to live by that statement. If I keep giving, God's just going to keep letting that conduit be open on the intake side. If I stop giving, God might stop giving to me. But givers always give. Think about this. Rivers always have enough water. I don't know why it is, right? Rivers give in and take out at all times. They're always taking in and they're always giving out on the other end. So be a giver, be a conduit, not a bucket. Work to have to give. If you're local, want to make sure I invite you guys out to our meetup group this Thursday night, 5:30. Junior Martin, and I think Junior's on this call, and Seth Hardy. Seth's also one of our speakers at the Free For All event. We're going to be talking about acquisitions. How are they acquiring? These guys are off-market guys, so they're going to be talking about how to acquire off-market properties. And if you guys can show up, it's going to be, I'm excited about this event because it's our first event back in our office since the fire. So if you guys are local, show up 5:30. We're going to start promptly right at 6 o'clock. We've been doing the 6:30 thing, but doors open at 5:30. Get there at 5:30, get some networking in, and we're going to start right at 6 o'clock. Excited to have Seth and Junior for that. People trying to figure out if there's any chats I need to be taught. John, are you cooking? Somebody wants to know if you're cooking at your event, and they're asking for a friend for some reason or something. So
no, I'm not.
I've seen John dance. I haven't seen him cook. I don't know if that's a good thing
no,
or a bad
you
thing.
don't want me to cook.
Well, without further ado, I'm going to get to Josh Belk again. Josh has been a friend of mine. Josh has been my CPA for 20 years. Josh saved me a ton of money a couple of years ago. He came to me and said, "Hey, Tom, like you're looking at a really large tax bill here. You need to make some changes. And I think he saved me $100,000 over the last couple of years in taxes, and super smart guy, and excited to have him. So welcome, Josh. I'm going to stop sharing here and you can kind of take the floor, and we're off to the races, sir.
All right, let me see if I can figure out the how to do this.
There you go.
All right. All right. I'm not sure what I'm looking at and what you're looking at. Are you guys seeing the preview, or are you seeing the entire screen? I have no idea.
I see both.
Okay. Well, maybe somebody smarter than I am can figure out. Let me see here. I don't know what I'm doing. I guess we'll stick with this and we'll run with it, because I don't know what I'm doing over here. So, okay. What I'm gonna do is just simply kind of give just a little bit of a primer on some of what has happened, mainly since last October, as it relates to the IRS, some of the initiatives that they have going on, and then some of the due to some of the changes. So one of the biggest impacts that we're seeing is the phase down of depreciation. That's going to be dropping. I'll explain that a little bit more, and then the conversation of Section 179 is going to become a larger part of the conversation, like it was prior to the Tax Cut and Jobs Act, for those of you who've been around for a few years prior to 2018. So since 2018, the tax landscape has changed quite a bit, and we're starting to see the pendulum swing back the other direction, and we'll talk a little bit about that. So I'm just going to kind of give a real high level overview of areas, then leave plenty of time, Tom, and please feel free to interrupt me or anybody else. Stop me, and if you have any questions, because this isn't for me. I do this all the time. This is for you guys. So,
so if you guys do have questions as he's going, just throw them in the chat, and then I will kind of talk back and forth with Josh. I asked Josh to do this for a couple of reasons. First of all, I keep seeing all these accountants doing their marketing, right? And they're like, if you don't change the way you're filing, you might owe an extra $50,000 in tax or whatever. And I'm like, okay, if I'm seeing these, I'm sure other people are seeing these. Now I actually got to talk to Josh about this from my personal end. He's like, no, you don't need to worry about that, Tom, because you actually do your taxes right. You handle your debt properly. And, we've already been implementing those. Those have been going on for quite some time. But I know, like Josh said, that some of these things that have been changing, I've got to take advantage of the depreciation on some certain assets over the last couple of years. And now they're starting to phase down those things. And also kind of like the whole mindset of the IRS, we've seen it change, I think, over the last 2 or 3 years. So that's why I had Josh call and do this call. Some of this is for me. I want to stay on top of this as much as I can, even though I have a good accountant, but you want to make sure you do that as well.
Okay, so I want to start, and I've mentioned this on a lot of the stages I've spoken on, and I think it provides a pretty good foundation or understanding in regards to the tax system as a whole. So when it comes to our tax system, it's not like this benevolent type of a structure, nor is it necessarily for redistribution of wealth, that type of thing. We've really seen the tax system become one that has become politicized. As well as our justice system, as we've seen even as recently as overnight. But the tax system, and I've been in a situation to where I've had the CI unit show up at my office, criminal investigation unit of the IRS come in. We've had to deal with some pretty ugly situations. We've dealt with some bad players in the IRS. We've actually had a situation where the FBI and the IRS were going at each other. Our client was an FBI agent, and there were some pretty ugly types of scenarios that go on. So we've seen kind of the good and the bad side of it on our side. But I think a good foundation for all of us to understand, because because sometimes people are trying to look for logic, like why is some things taxed like this, other things not, and why is that I can take deductions for these types of things. So all of these rules are basically in place for one big reason, and that is to get us as taxpayers to act in a certain way. So we can choose as taxpayers, as business owners, to deploy our capital, to operate our businesses in a certain way, that either can result in a lot of income, we pay a lot of taxes, can result in very little income or a lot of taxes, and then any kind of anywhere in between. So, but ultimately, the tax system is structured in a way to get those of us who are taxpayers to act in certain ways. And I'm going to use the Inflation Reduction Act that was just passed as a picture of this. Of course, the president actually just came out this last week admitting that the Inflation Reduction Act had nothing to do with inflation, that it was purely a clean energy bill primarily.
He literally said, "I wish I wouldn't have called it that."
Yeah, and so maybe the most coherent thing he said his entire presidency, but and the most true thing he said.
Yeah.
But we saw this with the Inflation Reduction Act, and essentially it's rewarding taxpayers, individuals and businesses for doing certain things, providing either credits or deductions for deploying capital in a certain way as it relates to clean energy. And I'll give a couple of examples of that in a few minutes. So kind of remember this, that the reason why we see these changes year over year over year isn't to try to necessarily drum up more money for the Treasury. They don't care. They just print more money. Okay, it isn't necessarily always for redistribution of wealth, although there is a very much a socialistic aspect to our tax system, but ultimately it is to get us as taxpayers to act in a certain way to basically to fund their political agenda, and that's really what the tax system has become. So much like a parent, if we do the things that they want us to do, they reward us. If you're thinking about when you're a kid growing up, if we did things they didn't want us to do, they punish us. So they tax us, for example, more if all of our income is active and is considered self-employment income. I have this additional tax I paid. Okay, if I go the other direction and if I leverage depreciation and losses, okay, however, I have other types of income, I could be subject to alternative minimum tax. So there are things that we kind of have to be aware of. So let me kind of just hop into this and just kind of talk through this. So this Inflation Reduction Act that was passed last year, as it related to the IRS, there were three big areas. Now, my podcast that went out last week, the one that's going out tomorrow, we do a little bit of a deeper dive into this. So the Inflation Reduction Act, primarily three areas that it was going to be focused on as it relates to the IRS enforcement. And I just want to touch on this because it's going to, I think, help you with a little bit of the mindset of the direction that both the Congress, the president, as well as the IRS, the direction that they're going. So the Inflation Reduction Act, primarily here, there are 84,000 agents coming after you, this type of thing. And first of all, I have to realize that the Inflation Reduction Act, as far as funding the IRS, is over 10 years. It is not something that all this is going to get hired. It's impossible for them to find that many people, train that many people, and move the enforcement. But there is an enforcement. Primarily, it is geared toward anyone making over $400,000 a year. Now, that's very arbitrary. And what we've seen in practicality, at least initially on the front end, is the audits more going back to the way they were prior to the kind of some of the defunding of the IRS under the Trump administration. So we're seeing most of the audits coming in for those under $400,000 that have Schedule C businesses, smaller operations. We are not seeing them yet at the $400,000 and above. So from a when standpoint, kind of understanding when you're preparing you're having your tax return prepared. If you're a business owner, you probably shouldn't be preparing your own. But when you're leaning into that tax professional, having that conversation, understanding that if you have a business that appears on a Schedule C, you're more likely to get audited versus one that has a separate return, such as a corporation or a partnership return, that there is more transparency as it relates to the balance sheet side. And also smaller businesses usually have a tendency to have less in place as far as structurally to make sure that the numbers are right. So a lot of times they're kind of doing their own books. They're just kind of doing their own returns, or they're using lower level tax professionals, that type of thing. So usually there's more meat on the bone for those types of businesses versus those that may be on a Schedule C or partnership. So the enforcement end. So that is part of it. The technology end, they're trying to do.
Go ahead. Just
Tom.
to hop in here, Josh. So you're saying
Yep.
that it was supposed to be for people making $400,000 or more, but what you're actually seeing is more of the really, really small business that's kind of doing all the stuff themselves. That's where you're seeing more of the actual audits come in.
Well, yeah, not necessarily that they're doing the returns themselves. So I'm trying to give a little bit of the logic behind the IRS and kind of what they're thinking. But they are what we have seen is the smaller Schedule C businesses getting audited. So those that might only have $100,000-$200,000 in revenue,
And
in top
Schedule
line revenue.
C, just to clarify, Schedule C is for what now?
Schedule C would be if you have a business that is not incorporated, not a partnership, single member LLC that has not made an election to be taxed as anything else.
Right.
So that would not include real estate, passive real estate investing, but it would include active real estate investing. So you're doing fixed flips, wholesale, whatever, going down that end would be considered active. So that would appear on a Schedule C versus a partnership return, which would be a multi-member LLC or a partnership, whether it's a general limited, and then or a corporation, S or C.
S corp or C corp. Yeah. Okay.
Correct. Okay. So the next piece is technology. They are really trying to the public facing side was a lot of discussion as far at least the marketing of this was to provide more technology to where there could be more communication with the IRS in a more fluid way, as well as being able to get data from the IRS. But the big part of this is really going to be for the IRS to be able to collect data on taxpayers as well. So it ends up kind of being a two-way street. So there's going to be more collecting of data by the IRS that essentially can get used against you. So more access to your records. So there is a big question in regards to privacy overreach. But ultimately, we gave a lot of it away a couple years ago during the pandemic, and this power grab. Once the government takes power, they rarely ever give it back. So in this case here, we opened the door for a lot of things and permitted them to do it. Unfortunately, that technology will probably get used against us, and I would not be surprised at all if AI becomes a part of this and they end up utilizing it as far as to evaluate returns and potential audit targets. And then thirdly, that of communication, and that has to do with the communication between the IRS and taxpayers and the IRS and tax professionals. So what we've seen in audits recently, more email, more singular points of contact, but we've also seen a lot more guilty till proven innocent, for lack of. I mean, obviously, this is I'm using a criminal standard to a more of a civil process, but basically the onus being more on the taxpayer to prove that the numbers are right versus the IRS saying that they're wrong. So it's been a more aggressive approach, and a lot of that has to do because most of the people they're hiring are inexperienced. They don't know what they're doing. So audits are taking 2 to 3 times as long as they used to, even though there might be a singular point of contact. So the situation, there are some positives, there are some negatives, but just kind of understanding there is a changing of the landscape to more evaluation by the IRS onto as it relates to individuals and businesses tax returns. Okay, some areas we need to be aware of as it relates to the tax landscape. Understanding is our income active or passive? And depending on the type of income is going to really depend on what type of tax strategies you use. So when we talk about real estate, for example, which can have a multiple different types of revenue streams, it's one of the more complex areas when it comes to tax. So one real big struggle that a lot of real estate investors have is how do I write down if I'm a fix and flipper, how do I offset and reduce that income versus with other tax strategies? You might be a passive investor, but not a real estate professional, so you're not able to leverage the losses. So then you have to look in other areas. So not to go to deep dive into this, but just really understanding within your structure, when you're keeping your numbers, when you're working with your tax professional, making sure you have those lanes broken apart and that you're utilizing the appropriate strategy to reduce that particular type of income. Because you can go through and you can invest. I hear somebody's audio in the background.
Somebody's unmuted. If you guys can mute yourself, that'd be great.
Great, thank you. So understanding, for example, if you're not a real estate professional, going through and leveraging a bunch of accelerated depreciation or getting into a fund that provides a multifamily fund, for example, that provides a lot of accelerated depreciation, you're not going to be able to use those losses if you're not a real estate professional. Okay, you're also, if you're not an accredited investor, and that means $1 million net worth excluding your personal residence, or if you're married $300,000 of AGI over the last 2 years, then you're going to have certain types of investments, such as solar credit, things of that nature, that are not necessarily going to be available to you. So these are things you want to kind of evaluate. So is your income active or passive? Understanding, do you qualify as a real estate professional? What doors are open for you? And then an accredited investor, one of those things, Tom knows this, before, when he wasn't an accredited investor years ago, there are certain doors that weren't open to him. Same thing for myself, because I invest in other businesses and do other things as well. So even for myself, for years, I wasn't an accredited investor. They changed the rules here a few years back. So the $300,000 in AGI hit that, consecutively year over year. But so because of that, there are doors that are open. So it's kind of one of those things you may hear people speak and talk about credits, talk about certain types of things, but understanding that that part of this, when it comes to your tax planning strategy, for example, evaluating that. If you don't have the $1 million in net worth, do you want to go ahead and make sure that you're paying a little bit more in income tax, so you show a $300,000 adjusted gross income, so you have these doors open to you? This is going to become more important as we get through with some of the changing landscape as it relates to the tax rules in the coming years, meaning that the depreciation may not be as available or isn't going to be as available. So you, being an accredited investor, to be able to get into a fund to where you can utilize the utilize the depreciation within that fund, or in a different way, it's going to become more valuable to you than buying another single family rental or multifamily and doing a cost seg and taking the depreciation on it. Okay, so understanding
Can you
active.
just hit on one
sorry.
thing on this, Josh? I think I go to a lot of conferences and they talk a lot about what, how do you become an accredited investor? It does. I agree with you. It seems like becoming an accredited investor is becoming more valuable even than it was 2 or 3 or 4 years ago. But the real estate professional, can you just hit on that? What makes somebody a real estate professional? And if you had several different LLCs, is it advantageous to be kind of a real estate professional in one of those? Or sometimes people I know use their wife to be a real estate professional while they're not, and that can kind of help in certain situations as well.
Yeah, so real estate professional, kind of rolling it up in a nutshell. First of all, 750 hours spent on the activity during the course of the year. Over 50% of your income needs to be derived from real estate activity. So if you have a W-2 income or other types of income, then for example, I'll give you an example. I may own real estate, okay, but my primary source of income comes from my accounting firm. So I have revenue from accounting firm. I own a daycare. I have a tutoring company. I have other companies that I invest in that I'm somewhat actively involved in. And I also owned a portfolio of 30 houses. Okay. Now, how would I be able to become a real estate professional? Well, even if I hit the 750 hours, if I'm managing my own properties, over half of my income comes from other activities. So it's just not the 750 hours. It has to be the 750 hours. It has to be at least half of your income needs to be come from that particular activity. So, and when you hit the real estate professional status, and it could be you as an individual. So, Tom, to kind of answer your question, it's not on a per entity; it's on you as an individual, or your spouse. So we have seen situations. Chandler's on the call, for example. Okay, so I'll use Chandler as an example. So Chandler was a medical professional for many years. He was a chiropractor. Now, during that time, that was his primary source of income. He owned real estate. Okay, and he's into notes. He has all kinds of other stuff too, but not to divulge too much, client confidential stuff here. So he invested in a lot of real estate type of activities, right? However, he would not have qualified as a real estate professional. Now, his wife, okay, Sherry, may have. Okay, so she may be the one that's kind of doing. So in that case, there he may leverage his wife's real estate professional status. Same thing, like like you, Tom. If you say, for example, you had a large real estate investment company, that's not real estate activity. But Becky, okay, your wife, if she's out there, selling properties as a real estate agent, okay, you would qualify as a real estate professional, or she would, and therefore you could leverage those losses. So why is that important? Is whether or not you can utilize any of your losses. So if you're not a real estate professional, then and you're not actively managing the real estate, you cannot take any of your losses. If you are active in the activity of real estate, however, not a real estate professional, you can take up to $25,000 in losses on your real estate. If you are a real estate professional, it is unlimited with certain exceptions, okay, as it relates to basis and other types of things that that I could bore you guys to death on, so we aren't going to go down that road, but just kind of understanding that there are potential pitfalls there as well. Okay. Another thing, just want to make you aware of alternative minimum tax. I talked about it a few minutes ago. We have more and more of our clients that are being affected by this. So if you do leverage the return that I was working on actually before this call, it's a client local to us, has about $2.2 million in excess depreciation losses on his tax return. Now, so he has an NOL on his tax return showing about $2 million. However, he had sold some of his real estate, long-term capital gains, and he also had some other long-term passive holdings that he had sold. Because of that, he ends up getting hit with alternative minimum tax, even though he has a large NOL. Once again, this is a whole like master's level class to try to explain AMT, but just to be aware of this, if this is a strategy you're utilizing, are a lot of losses, but you also have a lot of passive income, just to be aware that you may get hit with this 26% alternative minimum tax. Okay. So just once again, just trying to bring awareness here, not necessarily provide a whole lot of education. Okay. Now the short-term rentals versus a single family rentals. This is something that also we've been given a little more clarity on. So some of you probably own short-term rentals, sometimes called vacation rentals, Airbnb, whatever, Verbo, whatever, these nouns we turn into verbs. So the short-term rentals, the rules now, if it's 7 days or under, it's considered active. So if your average rental time at that property over the course of the year is 7 days, because initially, Tom, I think when I may have spoken at one of your events or on one of your calls, it was 30 days. Okay. Right. And so it's 7 days now. So it's just kind of understanding there. Now, this is important, and I'll talk about this here in a few moments, why this is important.
No, this is big time, Josh, because so this is a big deal for me, even because when we started the short-term rental game, we got up to 16 short-term rentals that were all the short-term, right? These were all like 7 days or less average stays. Now we've switched our model to midterm, and even though we do have maybe 2 houses that we allow 7 day, 7 days is the minimum now we have on all of our properties. And we only allow 7 days on 2 of our properties. The rest of our properties are a month minimum. So for us, like, this is going to switch most of one of my company's income from active income to passive income.
Right. And we actually did that, Tom, with one of your companies this last year. You probably weren't even aware of it. I don't know how deep of a dive you do into your returns, but your entity that has your short-term rentals, we did move it over. Because of the changes. Why is this important? So for 2 big reasons. Okay, first of all, if it's under the average rental is under 7 days at a time, okay, over the course of the year, then it is considered active, which means that, number one, it can be subject to self-employment tax. So it's no different than if you were fix and flipping properties, wholesale, whatever the case may be. Okay. So that's kind of the negative side. The positive side is at that point it's active, so you can leverage accelerated depreciation or bonus depreciation and offset it against other active income. To where if it's over 7 days, then it would be no different than a regular single family rental or longer term rental, 30 days or greater at a time. Then your losses there at that point would only be able to offset income from your traditional rental portfolio. Now, the next step in this that's going to be important is going to be in regards to Section 179 that I'll talk about here in just a moment. If I take this much time on a slide, Tom, we're going to be here till 3 o'clock this afternoon. So
sorry.
Let me pick up the page. No, this is fine. So Section 179, why this is important now, because of the depreciation phase down. Okay, so going from the 100% on accelerated depreciation on, so basically is land or leasehold improvements, any sort of personal property. So basically anything from the walls in on a property can be fully 100% deducted, okay, or expensed or depreciated essentially in the year that the property has been put into service. Now that's getting phased down. So it's going to 80% in 23. It's going to 60% in 24. So this is going to bring the conversation of using Section 179 back into play. Now the rules with Section 179 changed also back in 2018. So it used to be you could not use Section 179 at all in a rental property. Okay, but now you can use Section 179 if it's a long-term, mid or long-term rental. You can use Section 179 on appliances, carpet, so we're talking about those truly personal property items inside of a rental. You cannot use it for leasehold improvements, land improvements, those types of things. So it's not going to be as great of an impact, but however, as the phase down happens. So say, for example, in 2023, you do a cost check on a property, you're only able to write off 80%. You could write off the additional 20% of the personal property items using Section 179 to get you back to the 100% in certain portions of the cost segregation. Okay, so this also means that if you're going through and you're doing a rehab on a property, a remodel on a property, or putting a property in service, whatever the case may be, to do a better job of breaking apart your the components of the rehab. So you can because the standard of using Section 179 in an audit is going to be higher, meaning we're going to need something beyond the cost seg report to be able to use the Section 179 in those areas. So when you're going through and you're having work done inside, making sure that you have the carpeting broken apart on broken apart, appliances broken apart, just not a invoice from your contractor, property rehab or rehab of kitchen for $22,000, but you actually get a breakdown of the detail, and that detail is kept in your company records internally. So whether it's in your bookkeeping end, whatever the case may be, because this is going to be important as the depreciation landscape changes. Tom, was that clear? Or I don't know if anything.
Yeah, I do want to make sure that this is clear. I think, and I want to make sure I'm understanding too. So this is for rentals. This is not necessarily for a fix and flip because that's going to go in your COGS anyways.
Correct.
But for a rental, you want to break apart, each individual thing because you might be able to depreciate them differently. Is basically what I'm hearing here. So that's good to know. I mean, obviously, for us, like one of the benefits of short-term rentals, like you said, is we've been able to expense all of the staging stuff, your beds and all of that kind of stuff we've been able to expense. Now, obviously it doesn't make your P&L look very good either when you start a new property, but it's kind of like, it also helps you not pay taxes either on other active income. But now that our things are switching from, active income to passive income, well, now it's a whole different ball game now. So.
Okay, the QIP just means qualified in investment property. So that's personal property that I just referred to. De minimis rule, Tom, you just talked about you kind of mentioned this without intending to mention this, but when we talk about de minimis rules, safe harbor rules, you should have a policy in place to where a company policy to where any repairs on the property up to $2,500 you can expense immediately. So this will help with eliminating some of the need to capitalize some of the improvements that are smaller in nature. If you have audited financial statements, and I would be surprised if any of you do, you can actually have that up to $5,000 if you have audited financials. But otherwise, it's something you want to make sure you kind of have in your company policies. So we do this in our files for our clients, whether they know it or not. So Tom, I think we actually have one written for you. I think we actually, when we had this conversation, maybe 2 or 3 years ago when this changed. Yep. I think this actually was a result of something at one of your events that came up, and I mentioned this. But to make sure you have a policy in place, anything $2,500 or less, you can just directly expense. So if you have somebody going in and they're going in and doing some doing some remodeling work in a bedroom, for example, and it comes out to $2,300 instead of having to capitalize that over 27 and a half years to go ahead and expense it. Okay. And then the limits for Section 179 is 1.16. You can see the numbers on there. That is the amount of depreciation you can take. Section 179 expense, you can take additional depreciation you can take in a year. Okay. Up to $2.89 million in assets. Okay, so if you're over the essentially the 2.9 million in assets, you're not going to be able to utilize. At that point, you can no longer use Section 179.
Is this per LLC or per person?
This would be rolling everything up together. So like Tom and you, I'm sure many others on the call, I know Chandler, others that are on the call, they have a number of different companies and with different types of revenue streams, this type of thing. So we're going to roll everything together and it's all going to flow through to your individual return. So if you have a C Corp, okay, the rules will be different there, but we're talking about flow through entities. Okay.
Okay.
And there are different rules based, on autos and this type of thing. And once again, this is a whole complex area, but just to kind of just have in the back of your mind that this is one of the tools you want to have in your toolbox when it comes to the tax preparation side. If you need a little bit more depreciation, need a little bit more help to talk to your accountant about using Section 179 and to kind of maybe help close that gap some.
Yeah, I mean, I will tell you, every time I go to the family office club I'm a part of, they always talk about the safe harbor rules. And like the accountant that's there always hits this over and over and again. You got to do this stuff. The other thing that you touched on briefly that seems to be like it's a lot more of a big deal now is actually having written company policies for a lot of different things and having those in your records and keeping better records of those things is something that if you're not great at keeping bookkeeping, it's going to be even a bigger deal if you don't have those things come audit time. So make sure you guys keep good records and keep them in some kind of files for all this stuff. And company policies.
Hold on one second, Ben. What you need? Okay. All right. Okay. Okay. The other one big area that we're seeing a lot of clients get in trouble, and Tom, I am not monitoring the chat, so I don't know if I need to look through
some
that
of the
at all.
chat is just people talking back and forth.
Okay, gotcha. Okay, I don't know if I need to look at that or not for questions, but
I'm monitoring it.
Okay, good deal. Okay, so one thing another thing that has become extremely important, and this is something that changed last year, and I'm sorry, when I say last year, in 2021, and that's in regards to excess distributions in your entity and the result that it could have on taxation. So Tom, what I was referring to in the text message was this morning was specifically to this. So if you're running into a situation, and I think it's extremely important in two areas. First of all, I'm going to talk about the tax consequences of this, but I think more importantly, just from a business health perspective, that we understand some things. If we're going through, as a lot of investors do, they'll use kind of the old Burr method. They'll go through, they'll buy a property, they'll rehab it, they'll refinance it, and then reinvest it. The problem becomes that last R. Okay. What we're seeing happen, and this can happen either on purpose or on accident, okay, now or unintentionally, I should say, is that they go through and you do the refinance, you pull more cash out. Instead of leaving the cash in the business, it gets pulled out. So you end up running into a situation. So let me just kind of give you a scenario. You go through and you buy so you have a single entity that has a single property in it, $200,000. You buy the property for $200,000. You go through and you rehab it, and then you refinance it for $300,000. Okay, so now you have $300,000 you received essentially in cash on a property you paid $200,000. You did $50,000 in rehab. So now you have this excess of $50,000 in cash. If you pull that cash out of the entity, even if the entity has a loss, you're going to pay tax on that $50,000 because you don't have the basis in the entity to be able to take out that money. So to not get way in the weeds on this, if you go and you look at your balance sheet, okay, provided that the balance sheet's been prepared correctly, you go through and you look at your assets, you look at your liabilities. If your liabilities are greater than your assets and your company has a loss, or even if it has a gain, if you take more money out of your company than your net income or your basis, you're going to get taxed on that, on those distributions, even so if you, so I guess if you're kind of just kind of talk through, you're kind of visualizing this, and I guess by a graph here might be a little easier to see. But if you go through and essentially, if you don't have the basis in the company, meaning you have not put, you don't have enough equity in other assets, you don't have enough cash you put into the business previously, whatever the case may be, and you look down at that equity section and it shows a negative number in the equity section, and you take money out, you're going to get taxed on it. So not only are you going to, so say your company made $50,000, you took $100,000 above and beyond that $50,000 out of your company, then you're going to pay tax on the 150, even though your company only made 50,000. Okay, and that'll either get taxed as short-term or long-term capital gains. Now the issue becomes that essentially now your S corp, in that situation, you would end up with double taxation, because you're going to get hit with the paying tax on 100,000 on early distribution. The next year you make the 100,000, you didn't take any distributions out because you took it out the prior year. Now you're paying tax on $100,000 the next year. So be very, very conscientious of how you are using your debt, how you are pulling your money out of your company. If you're pulling cash out of your company and your company isn't making money, I mean, that just kind of like, that's big time stupid tax right there, right? Okay, you're going to pay ignorant debt up the wazoo, and you're going to pay in tax. You're going to pay it in company wealth. You're going to pay it in your inability to get bank money. Okay, so it's just kind of just bad all the way around. So I can't stress enough to be paying attention to your balance sheet. We love looking at P&Ls as business owners. Am I making money? How am I doing? My P&L is my last financial statement I look at as an accountant, and when I'm doing any sort of consultation with the business owner. The first financial statement I'm going to look at is my statement of cash flows. How is my client utilizing their money? You should look at your statement of cash flows. This can give you a snapshot over a specified period of time. So if I were to run a statement of cash flows from Jan 1 to July 31, I'm going to know right away how much money did I pull out of the company as the owner, how much money did I deploy into assets, and how much debt did I take on? And it's going to give me that picture right then and there, a year to date. So if I'm seeing a situation to where I took on a bunch of debt and I took a bunch of money out of the company and I haven't been acquiring assets, I have a problem. I have an additional tax problem, and I have a company health problem. Okay, yeah. So I think that's kind of one of those metrics or one of those areas that maybe even build a KPI around it to where you're analyzing that, to where it becomes one of your quarterly numbers that you're looking at when you have that quarterly call with your accountant. How is my equity section doing in my business? Am I able to, because this is going to be part and parcel of your conversation, or should be anyway, if you have an entity and you're running it properly, if you're going to do distributions, you're doing it properly, meaning you're not just taking money out of your business willy-nilly, but you're doing it in a structured way like you should be. Then quarterly, when you have those calls, you're doing your analysis, you're hopefully having that quarterly call with your accountant or your business advisor. Actually, how is my equity in my company doing? And then using that as one of the tools that you're going to use, not just your net income, but how is my business actually performing, and using that as one of the metrics in regards to you taking distributions out of your company.
But Josh, okay, all the gurus tell me that if I take a loan out, it's not taxed.
Okay, well, that is, okay, so you can, and that is true. But Tom, you work with a lot of business owners, how many of them actually have a loan document, actually execute it, and actually pay per the loan terms? I have one client in my entire portfolio that does it right. And I go over every quarter. I actually send them the loan documents, but they don't pay themselves back. The owner is not paying the company back. So if you can call it a loan if you want, but it's not a loan. And the IRS specifically looks at this. If you prepare a return and you say it's a loan, okay, however, there is no interest income on your tax return from the company of you paying the company back with interest, right then and there, they're automatically going to reclassify those loans as distributions. Right. You're not getting around it. Okay.
So I think the big moral of the story is, it's not necessarily taxable to take for your LLC to take a loan from a bank, but once that money gets transferred from the LLC to you personally, well, now this is where we have a problem. And like you said, then you're going to end up getting taxed on it again when you go to sell the property at some point. So it's I try to keep as much money as I can in the businesses. A lot of guys I don't understand why they don't want to. But I mean, my goal is to get the business so it spits off more income, not necessarily be able to pull necessarily cash out of it. So pulling cash out of things isn't always the best thing to do. And is this something that's changed, Josh? in this like mindset of how they're looking at this, or is this something that's always been, it's just never been scrutinized?
No, it's actually something that actually did change a couple years ago. So it used to be
I got you.
that that excess distributions were not taxed, but with the but that was one of the rule changes. Now the use of the losses has always been there. So if you end up in a situation to where you don't have your basis in your entity, but you're showing a loss, you can't take those losses. So if you go through and you have a company and you generate a massive amount of losses, but you don't have the equity and the basis and so there, and I'm once again, I don't want to go deep dive into this in regards to your stock basis versus your loan basis and all this other stuff, but just understand that you could end up with an additional tax exposure, or your inability to use your losses if you aren't managing your money properly.
Yeah.
Okay.
So
So
to do for
yeah,
everybody is to go look and see if you have a negative um
equity.
equity in your companies. And this is something a lot of people don't do themselves. Their accountant probably has to do for them at the end of the year and or adjust it to make sure that. So if you don't know what that is, please get with your accountant. So that's basically probably a to do for everybody to do. And then from there, just know that if you're going to start taking distributions and you have negative equity, you might end up having to pay tax.
Okay. Tom, what's our time? I mean, we're almost about 11 o'clock
Yeah,
Central.
again, like these calls normally go between 11 and 11:30. So
Okay.
it
All
kind
right.
of is dependent on the speaker.
Okay. Okay, 2023 changes. I'm just going to kind of quickly talk through this. 80% depreciation, talked about that at the phase down of the accelerated depreciation this year. Meals back to 50% deductible. So this would be all meals except for meals that you bring in. Like for example, if you ask employees to stay after hours, whatever the case may be, you have food brought in, that type of thing. Something I do quite frequently here at the firm.
Party.
But yeah, those types of things, those can be 100% deductible. But otherwise, your meals are 50% deductible. If you're holding an event, obviously the meals are 100% deductible, but this is more for you and for your team and how that gets expensed and with the client, if you're going out with a client or a potential investor, whatever the case may be. The Inflation Reduction Act had a clean energy component. So there's 30% energy tax credit for homeowners. This primarily has been focused on solar, which we've had clients go into. Now, you as an investor can't go through and put solar on your house and get the 30% credit on it. Okay. It has to be for a homeowner. So what ends up happening, and this is why being an accredited investor is important. There have been funds put together for this, but you have to be an accredited investor to get into the fund. The fund buys the credits from the homeowners. And a lot of this is very popular in California, some other states where this is a pretty big deal. So there's a strategy there and a very powerful one. We have a client out of Virginia that's big time into energy credits, into historical credits, this type of thing. Very powerful, something that's not talked about a whole lot, but it is a kind of one of those things. If you are a higher income earner, you have a lot of active income, you are an accredited investor, this may be something you may want to look into. Okay, is whether or not you want to get into a fund to provide tax credit instead of just talking about depreciation, retirement plans, kind of those things that you just hear talked about over and over and over again. Okay. So it is a very, very powerful tool. In the situation here with a client out of Virginia, you would not find a person more right wing than this guy, but he's like, you know what? If the government's going to give me 30% for green energy, I'm going to deploy some capital there. Gets the depreciation on the solar and also gets a 30% tax credit. It's incredibly powerful. Okay. And then electric vehicles, which is kind of a big one, so it has to be, new vehicle, 55,000. I'm sorry, not new vehicle. A vehicle, $55,000 if it's a car, 80,000 if it's a truck. It has to be under that amount. You have to be under certain income threshold, things of that nature. But there is a credit there for that as well, of which most of my clients don't qualify because their income's too high. Secure Act. That Tom, I'm sure in some of your groups this is talked about a lot. I know High Speed Alliance, for example, this is something that gets talked about quite frequently in regards to the Secure Act. So this is something I think we should be aware of. Catch-up contributions. So for I have on there for qualified plans, 401ks, 22.5, 30,000, additional 7,500 if you're to a certain age. So catch-up contribution, 529 roll-ups, which is kind of cool. If you have an unused 529, you can actually roll it into a Roth IRA up to $35,000, which is kind of a cool thing. I haven't heard anybody talk about this, but it's kind of
No,
really
me neither.
powerful.
That's the first I'm hearing it. That's
Yeah, so that's something that in the Secure Act is kind of cool that we've had a few clients take advantage of this year. And then qualified charitable distributions if you're over 70 and a half. So if you have a family member, something like that, we have a client that actually exited their business this last year, had a massive retirement plan, and so they took advantage of this. So 50,000 into if you're putting it into a charitable remainder trust, I don't want to get into all these crazy terms, but if it's not directly to a 501c3, it's a 50,000, or you can do up to 100,000 direct contribution out of your IRA or out of your retirement plan, and you don't have to pay taxes on it. So it's kind of a pretty cool tool. So just something that to kind of keep in the back of your mind if you have maybe an elderly family member, a parent, whatever the case may be, that may be benevolent, and it's something that's powerful. Then the required minimum distributions have gone from 70 and a half up to 70, or 72 up to 73. And that age will go up again here in a couple of years. So just some changes here with Secure Act.
There's one question here, Josh. It's a good question. Yeah. Regarding the 529 roll-ups, is this just a one-time push to the IRA?
Well, it'd be okay in its entirety. So meaning you're wanting to do it over time? Is that what you're asking?
I don't know.
Could you clarify? I mean, could you clarify the question?
Yeah. No, hey, this is Suresh here. No, thanks a lot, Josh. No, this is very helpful. No, but this is something I can actively work on it even today. Now, let's say I have $100,000 in my 529, and then I don't end up using it. Meaning like I used it, and then I have a remaining 100,000. So can I move like a 35K this year, a 35K next year?
I see. Okay, thank you. Thank you for the clarification. No, it's a one-time 35 grand. So okay. In your example, the remaining 65 would either have to be distributed or used toward its intended purposes.
And then to the Roth IRA, it's like you just you can directly push it, like it's as simple as like clicking a button.
Yep. Just go. So wherever you have it,
let's say I have in Fidelity. I have my Roth IRA in Fidelity, and I have my 529. So basically, I just push it from the 529 to the Roth. Okay.
That is correct. Yes. Mm-hmm.
And there's no tax implication. That's what you're saying. No, for the 35K.
Correct. Yeah, it's just like yeah, correct.
Okay, that's great. Thank you.
All right.
That was probably worth like 10 grand to some people on this call.
Yeah.
Yeah, no, I will agree. Yeah, thank you.
Okay. The rest of this time, it's just kind of more or less just kind of questions we've kind of already just kind of gone through, just kind of making sure we have metrics, understanding how we're using debt, how we're managing debt, our equity. We talked about that. Our surplus and reserves. How are we handling those things? So just some thoughts here that kind of wrap things up. But I know we're past 11 o'clock, so maybe any Q&A or anything that might be helpful.
Sure. If anybody has any questions, Josh, I don't mind I'm not sure how many more slides you have, but the people that stay, the people that got to go can go. I do think it is important to be proactive on taxes, and you shouldn't just have an accountant. You really almost need to have like a tax consultant. And if your accountant is not a tax consultant, then you probably need to find yourself a tax consultant. This is one of the things that the family office clubs have really kind of realized how valuable it really is. Because think about it, just this call, it was a free call. You guys didn't pay anything for it, but there are some people on this call that just saved $10,000 in tax. If you're in the 30% tax bracket and you can move $35,000, that's a big deal for, and not have to pay tax on the $35,000. That's a $10,000, hour. You just got paid $10,000 an hour for being on this call. And if you're not having regular conversations with people that are kind of like watchdogs, like Josh, like Seth, like other people I know that are really like into trying to help people understand the tax code and be proactive on making, because this is the problem, Josh. When do people look at this stuff, Josh? Tell me.
February, after the year ends.
And at that point, most of the time, it's too late.
Yeah.
So right now is a good time. I do think the middle of the year is the first, I shouldn't say the first time, but really it's a great time right now, July, August. It's a good time to start looking at this stuff, because sometimes these moves that you need to make in order to save yourself $100,000 in tax this year take some time. So, look at the stuff today. So I've got two questions here. First of all, from Linda, RMD is going to 73. What is the projected age increase and when?
I don't know that information off the top of my head, Tom. So let me uh
So while he's getting
oh,
that,
so it's 70. Let me see.
I'm pretty sure this is something that you can look up pretty easily.
Yeah, it is. I think it goes up to.
It's a gradual
Yeah,
raise, isn't it?
it is, and I'll have to look. I don't know what that number is off the top of my head, but it is going up.
And then the other question I see, Josh, are you taking on new clients? Somebody needs a tax guy for their business. I would like to give Josh an opportunity to let people
Okay,
know.
I have the answer here. It's 70, 75. So anybody that's 74 after 2032.
So it starts going up again in 22. So the next time it increases is 2032.
Yeah, so it goes to 70. Yeah, so 72 after 22, 73 after 33, 74 after. They're really weird the way they wrote this.
Yeah.
And then 75 after 32.
I haven't paid attention to it, Josh, because I kind of feel like they'll probably change it by the time I get to that.
Yeah, usually, in this type of thing, you're right. I mean, I don't really focus kind of like past a couple 2 to 3 years, because when we talk about 32 or 33, in all probability, it's going to get blown up. Just like, we're now going to be, we're starting to approach the sunset of the Tax Cut and Jobs Act.
You got
So
it.
now we're doing planning, so it's kind of moving targets sometimes.
So Josh does have a great podcast. I listen to probably half or more of them. Does a good job with it. So Josh, can you just give a little bit of information, and maybe if somebody can put it in the chat for us, how somebody can listen to your podcast or maybe get on your email list. And then if they're interested in consulting with you from an accounting standpoint, or maybe just a consultant, how would they get a hold of you?
Yeah, so somebody had asked in regards as far as working with us. We are kind of niche, and it's kind of one of those things that I would say probably over half we turn away that come to us. You're simply just out of capacity, and we want to work with clients we feel we can really bring a lot of value to. So most of our clients, 7, 8, 9-figure business owners, and so if you're kind of in that startup or perseverance stage, the first 2 stages of business, generally those are types of clients we generally don't work with, just really because there's not really a lot of need for tax strategy and that type of thing. So there's not really a whole lot of help that we can provide. But so yeah, if you're kind of a company that's been around for a while, you're making money, it's profitable, that type of thing, then we'd love to have a conversation. Lodestar.tax, LODESTAR .tax is the website. There's a connect with us link, I think, on there. You can always email me, Josh at lodestar.tax. And Belk on Business is the podcast. So YouTube, Apple, podcast, Spotify, wherever they're on. It's on all the platforms.
So lodestar.tax is a website, and then Josh at lodestar.tax. And then the podcast name is what again, Josh?
Belk on Business.
Belk on Business podcast. Awesome. Well, I do definitely appreciate you being on and investing in our community. If anybody has any last questions, Linda says great job. So thank you, Josh.
Thank you.
I know that I know it's interesting. Like this is one of this is one of those calls that people need to be on, but they don't always want to take the time to do. It's kind of one of those things that's important, but it's not urgent enough that they do. But the people that do pay attention to stuff really can save themselves a lot of money over the long haul. A lot of people say it's not what you make, it's what you keep. I kind of subscribe to that to a certain degree. I want to take it a step farther and say it's not what you make, it's what you keep, and then what also you can give. Because if you can make more and keep more, then you have more to actually put in the places that you think the money is going to be spent better, and you can make, you know, the impact that you want to make instead of whatever impact the government wants to make. You know, the one statement I want to revisit and just remind everybody, and this is something a lot of the people I know over the years have said, and then that is the tax system is built to get taxpayers to act in a certain way. It's not really political, although it's getting shifted to be political, because, you know, who's ever in office wants to make you act a certain way. And right now we are seeing some of those green energy and honestly energy credits all around is definitely a big deal. Becoming an accredited investor is a big deal. And keeping good records is a good deal. And, you know, kind of how you do things is very important. So if you guys don't have a good accountant, I highly recommend Josh Belk on that. He will be one of the speakers. You can connect with him in person at the free-for-all. So if you guys haven't gotten your tickets for that, make sure that happens, and make sure you guys are here September 7 through 9. That's all I got for today, guys. I'm just going to kind of, you know, let everybody go. I'm not going to go back to my slides. But if anybody has any questions, please get with me. If you're local, don't forget about the local meetup group. That's going to be this Thursday at the office, 2701 West 45th Avenue in Gary, Indiana. And if not, I will see a bunch of you guys I know at the free-for-all event on the 7th through the 9th of September. I don't have next month's call. So I know you guys, there's some regulars on here that are on every single call. I don't have the next call speakers. I've got a speaker that I really want to have, but I haven't confirmed him yet. And I want to remind everybody, we're not doing a September call. So we're not going to do a September call, and we're not going to do a September meetup group because the free-for-all is kind of taking, you know, all of my time for September. But I do want to at least let you guys know when the next call is going to be. So the next call is going to be October 3rd. So mark your calendars for that October 3rd at 10 a.m. Central. And the next local meetup group is going to be October 5th at 5:30 at our office, 2701 West 45th Avenue. All right, guys. Thank you, guys. Everybody have a good day. God bless. And thank you, Josh, again, for being on today.
Thanks, guys.
Have a good day.